You must have heard stories of how some employees of big companies like TCS or Infosys became crore in real life, irrespective of their monthly income. How was it possible? How can the employees of big companies become wealthy shareholders? This was all due to ESOP. ESOP is a scheme through which an employer offers to its employees an option to buy a company's shares as a reward for their work in the progress of the company in addition to the salary. Let us discuss the ESOP in detail. What is ESOP? An employee stock ownership plan, or ESOP, is a retirement plan that allows employees to become partial owners of the company they work for. That's right. ESOPs give employees a stake in the company's success, aligning their interests with that of the company. But how does it work? Generally, it is given to employees based on their performance or after completing a specified period in the company. For instance, Kotak Bank can offer its employee an ESOP option after an employee becomes VP in the firm. The crux behind this incentive is that the company wants its quality employees to not leave the firm and perform even more after receiving this incentive. Types of ESOP. Employee Stock Option Scheme, ESOS. This is the most used ESOP variant. The option given under this scheme provides the right and no obligation to the employee. Stock options are depending on terms and conditions, which includes vesting, required continued service for the company, etc. After the vesting period, the employee can exercise their right to stock options, and they will get shares by paying the predetermined exercise price of the scheme. Employee Stock Purchase Plan, ESPP. ESPP scheme allows the employee to buy the company's shares mostly at a lower price than the market price. This scheme is framed for offering shares to the shareholder in the process of public issue. The terms and conditions determine the period and exercising price of the company's shares by the employee. Stock Appreciation Rights, SARs, or Phantom Equity Plan. This is a different kind of scheme, in which employees are provided with cash payments. The cash payment is equal to the appreciation of the company's stock over a specified period. Therefore, compared to other ESOPs, SAR gives employees the benefit of equity upside without any exposure equity downside. SARs does not give equity ownership to the employees permanently. Restricted Stock Units, RSU. RSU plans awards employees with the right to receive shares on a predetermined date conditioned to the occurrence of a specified event or fulfillment of specified conditions. An RSU employee does not get shares immediately. In a certain and future event, the employee may also get partial dividends. What are the tax implications of ESOPs? The option given by the employer to the employee is not taxable. The vested option is also not taxable. When an employee exercises his right of buying shares, then the difference between the prevailing market price and the exercise price is taxable, according to the tax bracket under which an employee's income falls. The selling of shares by the employee is considered as capital gains. Now, if the employee will sell the shares within 1 year, then a 15% tax will be charged against the capital gains. If the employee sells after 1 year, it will be considered as long-term capital gains, and no charge will be charged against that. If an employee has ESOPs in a foreign company, a company based abroad, and if they will sell the shares of that company, it will be considered as short-term capital gains, and this will be added to the income of the employee who will be taxed according to the tax bracket under which their income falls. In the case of capital gains being a long-term, 10% tax will be charged without the benefit of indexation, or 20% tax will be charged with the benefit of indexation. So, in conclusion, ESOPs can be a valuable tool for both companies and employees, fostering a sense of ownership, loyalty, and shared success. Thanks for watching. Be sure to like, share, and subscribe for more informative videos. See you next time.